Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and today I'm joined by Jeff Levine, lead fin plan nerd at Kitces.com and chief planning partner at Buckingham Wealth Partners. He's also one of the two biggest Steelers fans ever to join the podcast. Welcome, Jeff.
It's good to be here. Good to be here. I'm assuming our good friend from Chicago, Mr. Portnoy, is the other one, huh?
Yeah. So is it going to be you or Brian? Who's the bigger fan?
Oh man, I don't want to get into a fight with him over this. I have a hard time ceding to him on this one, but I out of respect, we'll call it a draw.
We'll call it a draw. You did go to the playoff game. I don't think he was there. Just saying.
That's true. Although I was closer to, it was a short trip for me from St. Louis, and I happened to be in Kansas City the next day speaking. So it was kind of one of those, perfect scenarios where I just could not go to the game at that point.
Yeah. Well, as a Falcons fan, I can't criticize anyone or anything. So we'll jump right in. But so Jeff, you are famous in the Twitterverse for your extremely thorough deep dives into complex tax legislation. What's wrong with you, man? What's did no one hug you as a baby? Like what got you into this world?
Yeah, I don't even know how, I don't even know how it came to be. It was kind of like this evolution over time where I just started to get into new tax legislation because I just found it really interesting and people wanted to know, and everything I read was just boring. That's really honestly what it came down to. Not just boring for tax, but not just boring, but even boring for tax stuff, which is boring to the nth degree. And so I just kind of said, what can I do to make this a little bit more accessible, a little bit more fun? And so started breaking down things, in tweet strings and threads or whatever you want to call it. And then that wasn't really exciting enough for me. So I said, we gotta theme these somehow. And so we started, when I say we, I mean, started with The Simpsons, and then we have had The Office and Star Wars and Star Trek and mostly nerdy things over the years. The latest one I believe I did was Schitt's Creek. So it's tough because laws have gotten so obnoxiously long and complex now that I'm limited to the number of themes I can use because there's only so many shows that have 60 or 70 good GIFs out there or more, or for those who prefer GIFs. I know there's a very good debate on that, but that. So I like getting that information out, and I kind of look at it from a perspective of I'm going to be doing that work anyway. I have this obsessive need to know and to know right away. It's like that old show Monk. I don't know if you ever saw it, but he always be it's a gift and a curse. And it's the same thing. I just can't help myself. If something new is out there, I've got to go as deep as I can. I've got to know everything I can about that's relevant to the world that I live in, the financial planning and financial advising world right away. And then if I'm going to do that work, I might as well share it with others to help make their lives a little bit easier.
Well, I'm glad you do. And I know I speak for others. I've been the beneficiary of reading your threads and understanding things deeply that I never candidly would have taken the time to explore myself. Let's talk about the complexity. You talk about, only a season only a show like The Simpsons would provide you sort of an adequate enough GIF repository to do this. Let's talk about tax code and simplicity and complexity. There's this running joke that the government asks us to tally up what we owe in taxes to tell them, and then they tell us whether or not we are right. What is keeping us from a more simplified tax code? Is it really that complicated, or is there some sort of malice or subterfuge at play here where the complexity is sort of a feature and not a bug?
Well, I think you could probably find very good arguments on multiple sides of this issue. But for me, the complexity of the tax code largely comes down to special interests. And, we say that term often, we use the term special interest, and it has a very negative connotation, and for obvious reasons. But not all special interests are necessarily bad special interests. For instance, we have had a long running break in the tax code for contributions to charitable organizations. Now, there's certainly abuse there on a lot of fronts. Things like conservation easements are a hot topic now with the IRS, where people who never intend to develop land anyway give away the rights to develop the land that they were never going to develop in the first place, and we carry massive deductions. So there are certainly abuses of that, but at its highest level, giving to charity is something that should be encouraged, and there are good policy reasons to encourage folks to do that through tax policy. Now, there are certainly others who say people will give if they want to give, and they should give if they want to give. And if giving them a tax break is not going to be the thing that does it, you could see that incentives work. People are just, you're better at describing this than I am, given everything you do, but people respond to incentives, right? And so if we give a tax break for things, we see more of it. If we create a tax penalty for things, we see less of it. You see fewer people taking distributions from IRAs and 401ks before 59 and a half, because we discourage that by adding an additional 10% penalty on top of it. So the tax code can be used to sort of shift and shape individuals' decisions outside of just fiscal decisions. And it comes down to, do you want to do that with your tax code or do not? And just about every developed country in some way, shape, or form does use its tax policy to help shape behavior.
Yeah. So we are, weirdly enough, living at a time when your little part of the world is very much in vogue and very much discussed. And this concept of what constitutes paying a fair share is hotly contested. You hear this from all sides. Given that this is so much a part of the popular conversation right now, when you hear politicians and everyday folks talking about tax schemes and ideas, which ideas sort of make you cringe, and which ideas around taxation do you find to be widely misunderstood and misrepresented?
Oh boy, I would have to start with anything that is a wealth tax. I'm a big no when it comes to wealth taxes for a variety of reasons. And a few years ago, I really formalized this in an article I wrote for Forbes.com called something like to the effect of Elizabeth Warren and the very good, no bad, terrible wealth tax idea, or something like that. And it's not that I'm opposed, or not that I think that those who are the wealthiest of the wealthy shouldn't pay more or pay, quote unquote, their fair share. There's debate over what that is. But I don't think the wealth tax is the way to go about doing it. I think it's a really poor idea for any number of reasons, starting with the fact that there's a really good debate as to whether it's constitutional or not. When the Constitution was first created, we were not able to, taxes had to be apportioned to the states based on the number of people there were, right? So Virginia, you have, 30% of the population, therefore you're going to have to come up with 30% of the tax. Now, how you do it internally is your own selection, but you're responsible for 30% because you got 30% of the people. And then we ended up passing the amendment that allowed the income tax to be assessed effectively directly on an individual, not in proportion, right? A so-called non-capitation. And with that, it was a change, but it was only for the income tax. And everybody always points to say, well, what about the estate and the gift taxes? Isn't that a wealth tax? It's not. It's not a wealth tax. You can avoid the estate tax forever. Just don't die. Right? That's it. That's all you have to do. Don't die. Simple as that, right? Right. So with that in mind, it's not a tax on the actual wealth. It's a tax on the transferring of wealth from one person to it's the transfer event that is actually the taxable issue there, and not the accumulation of wealth. You can accumulate as much as you want during your lifetime. And if you give it all to charity, for instance, at your death, there's another way. You'll never pay it. But if you want to take your wealth and transfer it to someone else, then there's a tax imposed there. A wealth tax, in my opinion, and I'm not a constitutional scholar, but I spent enough time going through the tax code, and I think there'd be some very serious constitutional challenges there. And at the very least, even if it was struck down, let's say, by the Supreme Court, you're going to get this thing tied up in legal battles for years and years and years. Then, even if we say it would work perfectly well, like the Supreme Court comes out and somehow 9-0 unanimous, they say, no issues with this. I don't know why anybody ever had a question about this, which is not going to happen, but let's just go there for a moment. Then you have the need to actually enforce this. So right now we have an IRS that is way behind on its processing of, as we sit here and record this, we are well into 2022. And I am still waiting for my refund from last year, as are a lot of other people who timely filed returns. And those are income tax returns. Those are in many respects easier because the government has a lot of that information. You asked earlier about why doesn't the government just tell us, what our tax bill is? Because they only have some of the information, right? For certain people, if you're taking a standard deduction and your W-2 income, et cetera, well, all right, we can kind of run your tax return for you. But if you're a business owner, I don't know how much in expenses you had for the year. How do I determine what the net income of the business is, which then probably flows through to your personal tax return? In this case, when we're talking about a wealth tax, now I have to value that business every year. Businesses are notoriously difficult. Small businesses in particular are hard to value assets. Other very wealthy individuals, the ultra high net worth, tend to have a disproportionate ownership of small businesses and other hard to value assets. So now you're basically preparing what is essentially an estate tax return every single year with valuations. Not only is there cost involved in there on the taxpayer side, but also on the government side. How are you going to enforce? We don't have enough people to administer today's easier system. It's easier to say how much income in many cases you receive because, to your point, in many instances, not all, as we just pointed out, but in many, the IRS already has that information reported from other places. There's nothing there on your wealth, right? Your wealth is largely a unknown to the IRS. So just the administrative burden of that on both the IRS and the taxpayer would be exceedingly difficult on top of all the other issues there are.
Does the idea of taxing unrealized capital gains run into some of the same problems? It seems to me that the wealth tax and the tax on unrealized capital gains have some, I can see the sort of the populist appeal of sticking it to, really, really wealthy folks, but it seems very, very hard in practice.
Yeah, I and that has been my position on this all along. It's like, I get it, but curtail the step up in basis to some large degree, right? Make it a $50 million step up in basis so that you're only impacting those at the upper echelon and try to accomplish the same thing, or change the grantor. Look, the fact that we have a system where someone like me can talk with a client, right, and say, here's what we're going to do. We're going to create a trust. It's only going to work for estate tax purposes. And we're going to break the rules intentionally so that you continue to pay income tax on it at your own personal rate. So it's half in, half out, but only in the ways we want. That is absurd. Right now, will I continue to advocate for that strategy for clients today while it exists? Absolutely. But any rational person would say, this makes no sense. How can we have a system that incorporates policy like that? Same thing with even like the carried interest loophole. That's been around forever. Everybody says they don't like it. And yet for some reason, it's not some reason, it's special interest, we haven't been able to get rid of it, even though everyone says it's this gigantic loophole that exists. And instead, we're busy focusing on whether, mom or pop business owner can make their $6,000 or $7,000 backdoor Roth IRA contribution for the year. Like that's the hot button issue instead of fixing these big, much greater issues from a policy perspective towards wealth inequality. And, someone just yesterday, as a matter of fact, sent me an image basically showing how much tax the wealthiest in our country pay versus, the top 1% and what they pay in terms of the percentage of taxes versus, the bottom 50% having like 3% or whatever of the tax liability. And that's fine. That's all well and good to show that and say, well, look how much the wealthy are already paying. And while I'm not saying that, that they should have 100% of the tax burden, it's a chart like that, or simply saying, well, the top 1% already pay X percentage of, well, how much wealth do the top 1% already have? How much income goes to the top 1% compared to everyone else, right? That's our starting point, because you can't just look at how much tax one group pays without knowing how much they actually get. And then once you know how much they get, the next question is, how progressive or regressive do you want a system? I think most people inherently, their sense of fairness, most people, is that tax policy should be progressive. You have more, you should pay a little bit higher percentage. But there are a lot of people who still believe in a regressive system, to say like, hey, once you've reached a certain point, you've paid your share and your rate should drop back down, almost like the old corporate tax rate where it would go up a little bit and then it would drop back down. At some point, there are those who say, look, you've done your share. Now it's up to others. And that's a reasonable debate that, two well-informed individuals and well-intentioned individuals might disagree on.
Yeah, absolutely. So, it was interesting for me to hear you talk about the old system where states were supposed to pay in a way that was, effectively commensurate with the population. I think now there's a lot of talk about taker states versus, maker states. How do you see that playing out? I think in political circles, you're seeing politicians point at one another more often and say, look, you're in no position to do XYZ thing because you're from a state that's a net taker. Does this cause infighting? Does this cause strife? And is there anything that can be done about that?
It does create infighting and strife. And to your point, what can be done? Unfortunately, the only thing I think that can really be done is a greater education of the American public and of our politicians, frankly, and and a change in our era of the soundbite. Right, like right now, your 5-second soundbite that you say makes the news, and that's it. And that's all people hear. And nuance is lost, and context is lost. So the idea, for instance, the SALT deduction, right? That's been one of the hot button issues. And while not an exact one-to-one, there's been a lot of people when this SALT deduction has gone on over the past couple of years, right? For those listeners who aren't aware, like when we're talking about SALT, we're talking about state and local tax deductions. That's what SALT is short for. Prior to the Tax Cut and Jobs Act, at least for regular income tax, not AMT, but regular income tax, there was an unlimited amount of SALT expenses that could be deducted as an itemized deduction. The Tax Cut and Jobs Act capped that at $10,000 for both single filers as well as joint filers beginning in 2018. And since then, there has been this call on Democrats, because blue states tend to be a little bit higher in taxes, not across the board, but on average tend to be the higher tax states. And that SALT cap was largely seen as a giant middle finger to blue states. And blue state politicians, many, New York, California, New Jersey, among the largest proponents, there has been calls for, repeal this or give us relief, or we won't support your other initiatives. No SALT, no deal was a rallying cry last year of many Democrats as Build Back Better was under discussion. And there are opponents of that who say, hey, if your state is so mismanaged that you have to have taxes that are so high to support all these things, like that's your taxpayers' problem, that's your state's issue, not ours. And I get that. Like in a vacuum, that kind of makes sense. Like, hey, lower your taxes and then don't worry about it. But if you look at, you talked about takers and makers. I sometimes have referred to it as like net exporters of tax dollars versus net importers of tax dollars. But if you look at a state, let's say like New York or so forth, those high tax blue states, again, not across the board, not every state, but on average, tend to be net exporters of tax dollars, meaning they send more money to the government relative to the percentage of money or services that they get back from the federal government. So maybe, and I'm just making this number up for hypothetical and, to make the point, but let's say New York sends 10% of all taxes to the federal government. Maybe they only receive 7% of all the federal benefits that are dispersed to the states. Well, it's fair then to say, hey, if you'd give us our quote unquote fair share, right? Going back to that argument, like give us our 10% back. And now think of all the money we wouldn't have to tax people on to do the same thing. So nothing is ever as simple as it seems. There's always more below the surface. And so that's why I say like nuance and the backstory, context matters so much here. Rarely is something as black and white as the 5 or 10 second soundbite that we get by a 240 character tweet or a 5 second or 10 second audio or visual clip we see online or on television, et cetera.
Yeah, unfortunately, watching the vetting of the new potential Supreme Court justice, it seems like the era of the soundbite isn't going anywhere anytime soon, and it almost seems like all the questions are just sort of teed up to rile up the respective bases. So last political question, then we'll move on to happier things. You're elected president tomorrow. Okay, so leaving aside the intricacies of checks and balances and assuming you have a magic wand to wave, what immediate changes would you make to the tax code?
Immediate simplification across and true simplification. So not simplification that says, hey, we're going to go to a postcard. And instead of having, 2 pages of a tax return, we end up with a postcard, but 7 additional postcards that have to be filed with the one, like true simplification across the board. We'd probably have maybe fewer tax brackets, but all these deductions with crazy phase outs. First off, let's have standardized definitions of income. We talk about different types of income. We've got taxable income, we've got adjusted gross income, we've got provisional income, we have 75 million different versions of modified adjusted gross income for every which purpose under the tax code. Like, let's simplify that. Let's simplify the deductions for most individuals, right? Let's make it easy for individuals to file their taxes. I would also say that we probably need to have some sort of better alternative minimum tax system. It is, and this goes to, I guess, a little bit of personal feelings, but I do think there is something to the idea that Warren Buffett should not be paying a lower rate than his secretary, right? The famous line. I think there's something to that. And I understand the need for tax advantages to get capital invested, right? To offer some sort of treat for investors to say, if you do this, if you put your money into a business and it does well, there's a tax incentive for you at the end of the rainbow. But this idea that, you can do that and then through a whole means of assorted tax breaks, kind of drive your tax bill down to 0 or negative or even close, like those types of things probably need to be eliminated to a large degree. I think in addition to that, we've got way too much going on in specific provisions in the tax code for very, very specific things. I mean, sometimes you're reading it and it's like, you go through and you find a provision. It's like, okay, if your name starts with an A and you were born on March 14th of this year and you live at latitude this and longitude this, then here's a break. Now, anybody who happens to meet those specifications, you get this, but it's clear. Years ago, I remember in the retirement area, there was a provision in there for bankrupt airlines. And it was like, well, if you're an airline that's a federal, national airline, and you happen to go bankrupt on this day, which it was only American Airlines. So like, okay, why don't we just call this the American Airlines provision? Let's just be honest about this. This isn't like, hey, if you happen to have an airline that starts with an A and have an American in the name, like it's kind of ridiculous. So all that stuff needs to get out. And honestly, the only way that would ever happen, and maybe I'm going too far, and I'm probably gonna alienate like half the people that may have listened to me before, but we got to get money out of the two things I would change along with the tax code to keep it in a fair, quote unquote, shape. Money in politics has to be addressed, and gerrymandering has to be addressed. I think those two issues are absolutely critical. I don't care which side of the aisle you're on. If you are a supporter to me of democracy, then gerrymandering is a clear distortion of that. I don't know how anybody could reasonably say that this is an honest way to go about selecting it's clearly just meant to keep people in power. And money in the same way. Like, you should not be able to buy influence with elected politicians. And if you look at the groups that spend money, there's all these breaks in there for, we got these breaks for oil and gas, and we got these breaks for farmers, and we've got these breaks for this sort of, like, it just bogs down and clogs up the tax code to where it makes it much more difficult for the everyday, man or woman who's looking to do their tax returns to make sure they're maximizing everything available at their disposal.
Well, let's talk about that average man or woman for a minute. For the average person, what's sort of the cascade, if you will? What are the most common sense steps they can take to minimize their tax impact? And it's like, once you've done this, move to this, and so on.
I mean, at the highest level, you've got like your bread and butter type of things, like, are you contributing to your retirement accounts, or are you contributing to an HSA? Those sorts of tax preferenced accounts that most people who are at least working today have some sort of access to. And if not directly through work, then you've got IRAs, et cetera, that you may have access to. Beyond that, then looking at your specific situation as an individual. Today, because of the very high standard deduction, very few people itemize. A way to try and break that cycle, if you will, is to potentially bunch deductions together. That's more important now than it used to be, because if you're itemizing normally and you go back to a deduction that's a standard deduction, rather, that's half of today's amount, well, more people would have the ability to get above that standard deduction kind of naturally, if you will. Today, we've almost got to force the issue, because for a married couple, we've got a $26,000 roughly standard deduction. The most you can have in state and local taxes under the rules is $10,000. So where are you getting the other $16,000 from? Maybe you've got mortgage interest of $8,000. Okay, that still leaves you like $8,000 short. If you give away $5,000 every year to charity, you never get there naturally. When I say natural, I mean just kind of doing your regular contributions each year. So your 10 from state taxes, hypothetically, your 8 from your mortgage interest, add 5 is 23 total. But if your standard deduction is 26, you're always short. So artificially beefing up certain years through kind of bunching. So to say, all right, I'm going to put 3 years worth of contributions into a donor advised fund. I'm going to contribute $15,000 this year, but I'm not going to do anything for the next 2 years. Well, now in that 1 year, you've got 10,000 plus 15,000 is 25 plus 8 is 33. And now you're actually getting a tax break for at least some of your charitable contributions. So that is absolutely critical. And then, being today, a lot of people have either own their own businesses, or they've got a side job, the gig economy, so to speak. They've got something else where they have the ability to have their own business deductions. And there it's a matter of, what can we find that's quote unquote ordinary and necessary expense of that business. So that could be everything from maximizing an unused piece of your house to use as a home office, right? That you could say and set aside exclusively for that purpose. Or maybe it's keeping track of the mileage you have, or maybe it's some of your home internet use is allocated towards. I mean, every situation is going to be different, and it's a facts and circumstances argument. It's why, people always ask, is it deductible? My answer is, I don't know. Tell me about your situation. Because sometimes you get these really wild things that you'd say can never be deductible, but in certain cases they actually are because of those unique facts and circumstances of a taxpayer. So I think the other thing that people should really consider is, at least every once in a while, find a tax professional to speak with. I don't do a lot of tax returns anymore. I'm not, I'm not looking to do tax returns. I don't want to do any more tax returns. I'm so happy to not do them anymore. But I value my tax professionals because having that other set of eyes to point things out, even if you don't use them every year, having someone, every 5 years or something like that, say, hey, have you thought about this or that? I certainly see the benefit of passing that off to others on a regular basis. But for those who don't, sometimes just that second opinion, even if not from a tax professional, talking with your financial advisor who's knowledgeable about these things as well, that can be valuable to do that. Even small businesses, the business tax deduction today could be 20% of that business profit. That could be huge. We're talking about tens, if not hundreds of thousands of dollars for some individuals. But how that business is structured and whether it owns property or how much it pays in wages, these are all items that can go into creating very, very large deductions for some individuals, but they're complicated things, and you often need professional guidance for those sorts of things.
It's interesting, even though I work in finance, I consider tax sort of a part of the financial world that I find sort of scary and overwhelming. And even sort of my joke at the outset of our conversation is like, who goes into this? Just a few years ago, I learned about HSAs. Like, I'm embarrassed to say, I've only been contributing to an HSA for like the last 3 or 4 years because it took me working with a professional to say, hey, you should be doing this. Same with a SEP IRA when I was self-employed. That was a huge, huge tax benefit to me that I had no idea about until I worked with a professional. Missed some good years there because I wasn't informed. You talked about the sort of it depends nature of whether or not something is able to be written off. What are a couple of the strangest things you've ever seen written off, just for my own amusement here?
Yeah, I've seen all sorts of weird ones over the years, either on clients that I've had the pleasure of working with, or at least try to write off, I should say. People say, let's deduct this. Like, I don't know about that one. Or also on returns that advisors have shared with me for clients and situations. So I think the strangest thing I've ever actually seen, written off has to be, or at least one of them has to be a zonkey. A zebra donkey hybrid of someone who is depreciating the zonkey over, there are certain schedules over which you can depreciate farm animals. They're like the tax code. When we talk about the complicated tax code, it is really like we could depreciate animals over a specified number of years. And so this individual had zonkies on their farm. But there's all sorts of, there's a classic case from the 1960s, I believe it is. So going back, 6 decades now, but an individual who tried to deduct, I think it was clarinet lessons for their child as a medical expense deduction. And originally the IRS, no, they're clarinet lessons. You don't get to deduct fun things for your kid. And it turns out that playing the clarinet and having these lessons significantly helped that child's overbite. They had a really bad overbite, and the clarinet lessons and playing the clarinet really reduced the pain of that. And so ultimately, I think it was the tax court actually who said, in this unique situation, it will be classified as a medical expense deduction. Normally boats are not deductible, right? People are like, oh, I need my boat for my business because I take people out. That's one of the classic ones where everybody tries to deduct it, and all the CPAs like, no. You're not getting this. And, but there are some people who legitimately operate like, I have a boating business and I'm going to, there it's deductible. So almost everything is a facts and circumstances argument, even to the extent of I used to do a lot of returns for news reporters. And they, the standard rule is if you can wear your outfit that you buy kind of regularly, right, then you can't deduct it. So if I wear this all the time, right? I'm always I say this, I'm in a vest, right? Because I'm always in a vest. That's my thing, right? I'm a retirement nut. I always want to be fully vested. Get it on. Okay. So anyway, I'm always in a vest, but I could wear this vest anywhere. It's fit for regular wearing. So even though I don't, but let's say I went and I got the finest custom made vests all the time. Because I can wear them anywhere, they're not deductible. But a news reporter who maybe wears makeup on their face, and because they wear makeup, they end up smudging that suit or uniform or whatever it may be, or that dress that they're wearing, so much so that it can't really be worn elsewhere. Well, now that could potentially be deductible. Same with their makeup, right? Normally buying makeup for anybody who purchases it would not be deductible. But if I'm using it for my job and I'm a self-employed individual, now it's deductible. So it's all in the business realm in particular. You get into all these facts and circumstances arguments that, in most instances, never become an issue because the overwhelming majority of returns today are just not audited. And we talked about before, the IRS does not have the resources to keep up with these things. But when the IRS does ask questions, that's where you've got to be able to justify these things and say, no, this is legitimate for my specific business. And what's deductible for a music teacher may not be deductible for a financial advisor, may not be deductible for a farmer.
Yeah, I was going to say, it seems like I understand the circumstantial nature and the subjective nature of some of the examples you gave. It also seems like, for me, an audit-averse individual, I'm always sort of trying to stay 100 miles away from anything questionable. So I guess the question you have to ask yourself is, how willing am I to fight the good fight if I get called to task on these things?
100%. I think, we are so familiar with the concept of investment risk and tolerance or lack thereof of that risk. There is also, for some individuals at least, where there is not a black and white, there is a tax risk tolerance. And you might want to push the envelope more or less on certain things based on that tax risk tolerance. And ultimately, a good tax professional should also tell you sometimes, like, it's not worth it. Like you're talking about $100 here. If the IRS questions this, it's going to cost you, $10,000 to defend yourself. Just give up the $100 deduction, which is only going to save you $40 in taxes anyway. Move on with your life and find better things to argue about. But there are some legitimate things. I talked about conservation easements earlier. Massive issue right now with the IRS, super big hot button issue. There are, judgment calls to be made. Same thing with an S corporation. One of the hot button issues there is always how much should an owner pay themselves. The IRS says you must pay yourself as the owner / employee of an S corporation a reasonable salary. And that's important because your salary component is subject to employment taxes, but your profits are not. And that's why a lot of small business owners love the S corporation structure, because maybe they've got $150,000 of total quote unquote profit, and they only pay themselves $60,000. And so now $90,000 escapes employment taxes, where if they were a sole proprietor, they would have self-employment tax, let's say, on the whole thing. Again, how far do you want to push the envelope? Like, reasonable is a range.
Yeah.
And, there's not like one number to say like, okay, you must pay yourself this. But obviously, the further lower you go on that reasonable range, the more you increase your potential risk of an IRS challenge. Whereas the more conservative you go, which every dollar above the minimum amount, like if you could somehow, IRS told you, $62,496 is what we deem reasonable. Yeah. Well, every dollar you go above that, you're effectively costing yourself money, but you don't know that number unless you're audited. So how do you go about arguing that and creating that, and how far do you want to push? There's a million and one things on a tax return that go into that either gray area of can you or can you not, because there's just not enough guidance, or it's a judgment call as to how much or how little of something fits a bill. And that's where a good tax advisor comes in. And I point out one other thing too, since I know this, so many, the overall majority of advisors here, or at least many are, listeners, I should say, are advisors. The question always comes up, am I giving tax advice? Am I going too far? And, one of my, standard, I'm like, no, you're like showing somebody an illustration about, hey, if you do a Roth conversion, here's what this would look like in the future, or here's what we would project this looks like in the future. That's not tax advice. It's no more tax advice than saying, hey, did you make your IRA contribution for the year? Well, why didn't you say about a Roth IRA contribution? Or when you sold assets, did you realize that the $3,000 capital gain would push them $249 over their Medicare Part B threshold and cost them? Like, everything you do is ultimately tax related as an advisor. Tax advice is saying to someone, pay yourself $72,000 of salary and leave. That's tax advice, right? This is a gray area where you are coming in as a professional saying, this is what you should do in this. It's not a rule, right? This is what you should do. Whereas, saying to someone, listen, tax rates might go up in the future. If we illustrate that here and I project a 5% increase in the tax rates going forward, a Roth conversion would make sense, as you can see here. That's just an illustration, right? That's just a projection. That's not tax advice. And so I think advisors need to get comfortable getting into the weeds there. Everything we see from consumers and research is showing that, especially for those with the mass affluent and up, so mass affluent, high net worth, ultra high net worth, and then ultra high net worth, they all are looking for that tax advice. That's the big thing that people want today. And the irony is that even though the top tax rates have gone down so dramatically, it seems taxes are more of a hot button issue for folks than ever before.
So for my final question, let's give some love to those same advisors. As certain parts of an advisor's value proposition have become increasingly commoditized, you're starting to hear about tax alpha more and more as a means to differentiate yourself from the crowd. What can advisors do with respect to tax to set themselves apart from the crowd without crossing the line that you've just discussed?
Yeah, that's a great question. I think there are a series of things that you can do in this area. First off is once your client has a tax return prepared for the year, look at it. Understand what happened, right? That's the very first thing. Do a review of the prior year's tax return. Make sure that everything that you did was, reported properly there. I've seen so many instances where the advisor comes up with a great idea, like, hey, let's use a QCD to give to charity. And then you look at the tax return and it's not reported. There's no QCD reported. And, the client says, well, doesn't my CPA know this? No, because there's a lot that's on a return or that gets reported that you actually have to tell the CPA what went on. And there's a lack of communication there between advisor and client and tax preparer. So the first thing is just looking at the prior year return, gathering information, making sure you're aware of everything that's going on. You might learn some new things about the client you weren't aware of before. But in addition to that, checking to make sure that the things you do know about for the prior year are actually reflected appropriately on the return. Next, I would say either doing it yourself, and there's more software available today for advisors than ever before, but if not yourself, working hand in hand with a tax preparer to do some projections as you get later into the year, at least for most individuals. Especially if you're thinking about doing things like Roth conversions or taking gains and pulling off, certain amounts from a taxable account, perhaps taking advantage of the 0% long-term capital gains rate. You want to do projections oftentimes later in the year, late October, maybe November, et cetera, after the extended deadline has passed. Get those CPAs involved and do those projections so that you have a better handle on what's actually happening for the year. So you know how much to convert or how much to take as gain or how big a deduction it makes sense to give this year to charity or whatever have you, like doing those later year tax projections. And then obviously there's the portfolio element, which includes, properly executing tax loss harvesting. That's largely automated for many advisors today, but still there's value to be had there. Tax location, asset location is still a huge value add for a lot of advisors or for a lot of clients that is not a current part of their portfolio. When we're talking about that is essentially overlaying your asset allocation pie over your asset location pie, right? Taking your taxable, your tax deferred, your tax-free accounts, if you think of that as a pie chart, and overlaying that pie chart on the pie chart of your other investments. Where do you put your stocks? Do they go into your traditional IRA or the Roth or the taxable account? Like doing that appropriately can add significant, net return to the client's portfolio. And then I think lastly, it's looking multi-year. One of the things I say over and over and over when I'm working with advisors or doing education workshops, et cetera, is the winner of the tax planning game is not he or she who pays the lowest tax bill in any one year. It's he or she who pays the lowest tax bill over their lifetime. And in some cases, actually, because many of our clients have done so well, it's not only their lifetime, it's their lifetime plus perhaps their children or even their grandchildren's lifetime. So looking at it over that extended period of time, sometimes the things that we recommend will have a detrimental effect on the client's current year tax return, but over the long term, it's a home run. Getting clients to focus on that long term and to buy into the philosophy that current year tax bills matter, but to a much, much, much lesser degree than does your lifetime tax bill. I think those are 4 areas where advisors can continue to provide a ton of value in the tax planning area.
It's, you've drawn some really great analogies. I hear, you sort of analogize the risk tolerance investors have for taking on portfolio risk versus sort of the sort of line you want to walk with respect to a potential audit. Talked about long-termism versus short-termism, which is, of course, an investment trade-off as old as time. So this is a part of the world where I think advisors can do a ton to set themselves apart. They can add a ton of value in a really unsexy way that I don't think clients are always looking for, but the impact can be tremendous. So I'm thankful for smart people like you who take these things, break them down, make them accessible for people like me who are in the business but still a little scared off by this particular part of the world. So you're doing important work. If people want to follow this important work, where can they read your stuff? Where can they find your Simpson gift breakdowns of complex legislation?
Well, thank you for the opportunity to be here with you today and to have an opportunity to visit with your listeners. I would say certainly Twitter is always a great place. So you can hop on Twitter and follow me at CPA Planner. Again, that's CPA Planner. Also on LinkedIn. Beyond that, I write fairly regularly for the Nerd's Eye View at kitsis.com and am constantly putting out additional information on the Buckingham website as well. So Buckingham Strategic Wealth. And, I'm kind of like a bad penny. I turn up all over the place from time to time. So it's, I can't help myself. I really love this stuff. And once again, kind of circling back to where we started, I look at it and say, if I'm going to do this work, I want to share it with as many people as possible, because one of the things that I really don't like about our system today, you asked, maybe I'll end with the comment of, I would create a tax system where, if I could wave the magic wand, I would create a tax system where people wouldn't be able to pay less than someone else simply because they had better access to individuals like, myself, yourself, other professionals out there. That seems really unfair to me, that access to experts. And I know education and information is always power, and you're going to find that, in anything, right? You go to the best doctors, you go to the best lawyers, you go to the best accountants and financial advisors, et cetera. But when it comes to taxes, there's just something that seems inherently icky to me about the difference in taxes that people may pay because they're not aware of all the nuances and intricacies of an obscenely archaic and complex system.
Well, I think I can think of no better ending. And I think that your work educates the masses so that we know what to advocate for, and we can advocate for a system that is more egalitarian, less icky, and fair in the truest sense of the word. So thank you for the important work that you're doing. Everyone go follow Jeff. Thanks again for your time today.
Thank you.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.